Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we welcome back DB from OrderFlowAnalytics for a continuation webinar on order flow and game theory. This is actually part 2 in a series of webinars. If you missed part 1, I highly recommend you check it out. You can find it on BMT by clicking webinars and just scrolling through the archives. Today, excuse me, some of the bullet points that DB will discuss include using volume as a strategy, tick-by-tick trading, order flow execution and management, and decision point trading using volume cluster analysis. I do want to remind everybody the webinar is being recorded. If you are watching the recording at a later date on YouTube, please do me a favor and give us a thumbs up. It does help us out. Also, DB has asked that we hold questions until the end of the presentation, so please do me a favor and keep that in mind. If you guys start asking questions as we go, they're likely to be out of context, and I'm not going to really know what the question pertains to, so it would be better to hold the questions until the end or to be very clear with the question so that when I come back to it at the end of the webinar, we know what it was in regards to. All right, guys, give me 1 second, and I'm going to turn things over to DB. All right, you should have control.
Okay, give me just a minute to figure out which monitor I need to pull up.
Sure. All right, we got it.
All right, excellent. That's not where we need to go. All right, there we go. Hello, everyone. I'm glad to be back presenting again. I hope everybody survived the summer. Thanks, Mike, for having me back. In my last webinar, I broke the ice using some basic game theory concepts, and the hope was that you'd see a correlation between relatively simple games and the thought process required to effectively engage the market. If you missed that event, I'd suggest taking an hour or so to review it on the forum, but I'm going to give a quick recap to catch everyone up. This is not going to be repetition. We started with a game in which I gave you a button and $100, and your only action in the game was to decide whether to push the button or not, kind of like putting on a trade. The results of that game were dependent on your strategy, expected payoff, understanding of the participants that you were playing against, and the rules, or in game theory, what we refer to as common knowledge. At the end of the game, several of you actually maintained a profit, and many were flat broke. Again, a lot like trading. That exercise was a variation of a basic game designed to show you that even when the details are spelled out in an extremely straightforward manner, an unusually large number of people lack the ability to formulate a rational strategy or to grasp the nature of the people that they're playing against. My underlying comment was that either the game of trading is inherently dangerous to a small pool of novice traders who can't figure out when or how to push the button correctly, or common knowledge of trading information isn't really common knowledge at all. This is where I introduced the notion of order flow charting as a means to organize and read the print. That was the focus. How does the average novice trader access and utilize the common knowledge that's available to everyone before deciding whether or not to push that button? I dismissed a few concepts like delta analysis and cumulative delta studies as kind of inaccurately portraying the value behind the flow of orders. And I also introduced the idea of volume cluster analysis as being a valuable tool, but still not really a process of reading the print. Instead, I gave you 3 basic rules for properly reading the print and explained how simple OFA Ninja makes that process of finding things like buying momentum that you can see highlighted here in this ES chart. First, you have to have and understand directional price action. We use a process called probe and rotation periods to do this, where the wick color of a period tells us the directional strength, and the body is totally independent based on the open and close, just like a regular candle chart. I'm going to try and zoom in here, so bear with me. There we go. In this example, you can see a green candle body in the last period, but it also shows a probe down with a red wick. This might indicate that the momentum expansion is over, since the period lifted off the momentum levels and then was forced back down with a strong probe off the top. See, adding the element of directional strength in addition to the standard open, high, low, close data, it's a great help in making sense of the print. Second, the strength or weakness of a print needs to be compared diagonally rather than as a delta calculation. In the auction process, the bid and ask are never the same price at the same time. So comparing them as though they are is just kind of ridiculous. Instead, the ask print at a price should determine the strength or weakness of the bid print at the price below, and vice versa, just as they occur naturally in the auction process. It can't be simple addition or subtraction. We need comparative ratios relative to the thickness of the instrument's volume. Sorry, still learning how to zoom on this new presenting stuff. Look at the 2775 print in this last period here. We have 5,873 at the bid and 4,915 at the ask. Now in the land of delta, this means negative 958, or almost 1,000 more contracts at the bid than at the ask. And to some, that would show strength to the sell side. But there's absolutely no way that volume was trading at both the bid and the ask of 2775 at the same time. In fact, when we were printing this 4,915 contracts at the 2775 offer, we were in the process of printing 4,609 contracts at the 2750 bid. Okay? Just as when we were printing those 5,873 contracts at the 2775 bid, we were in the process of printing 6,877 contracts at the 28 even offer. If you look at how the volume actually entered the market, bid to ask, and you understand that there is never one fixed price in an auction, then you simply cannot argue that a linear delta calculation brings logic to the trading floor. And finally, a strong or weak print by itself really means nothing. So sequences of values create recognizable patterns, just as the sequences of strong ask prints, represented in green here on the chart, clearly show an upward buying momentum on this ES chart. So why game theory, you might be asking? What do these silly games have to do with actually taking a trade? Well, once again, I want to encourage you to think before you trade, before you buy the next magic software, before you sit through another 30-day trading room trial. Do you have the tools to formulate a strategy? Do you understand the payoffs and risk? Do you know who you're trading against? Do you have the same information they do? Are you in that pool of novice traders, unsure when to push the button? Or do you really understand the concept of common knowledge and how to apply it? Now, I'm not suggesting that you need a doctorate in quantitative finance or master's in financial engineering, but a basic understanding of strategic, interactive decision-making should make your approach to trading more clear. As traders, we're groups of individuals, you, me, them, each with our own beliefs, goals, and information, and we're responding to the decision of others. So let's flip that around a little bit into they, representing professionals, institutions, algorithms, liquidating you, the novice individual trader. They're going to ask, what's the best way to play the game that we're in? And how do we recognize games that we're not so good at? And if we get stuck in that type of game, how can we change the game so we might do better? Novice traders don't ask these questions. Instead, they ask things like, Does this setup work in every market, in every time frame? You know, it's insanity. Zero concept of alpha, risk, or market regime. They're just looking for ways to game the system instead of models to understand the game. We call it ex post rationality, which means that you're more likely to look backwards to see how earlier situations could have been done better than you are to look forward and examine the current situation in its own right. Now, ex post rationality in trading is called backtesting. It's been the retail trading industry standard for years. We set up a system, we run it against historical data, we optimize the results. Sometimes we optimize the data set, which certainly helps if you're selling something. And then we make assumptions about the future results that we should expect. It's kind of funny that we see this disclaimer everywhere, though, isn't it? We're basically warned daily that this is a terrible idea, but yet the same thing continues anyway. It's pretty sad, really. OFA teaches a different modeling process. We believe complex systems, which the markets certainly are, require a balanced approach of historical probabilities matched with a great deal of emphasis on examining the current situation, the print and the actions of others, in order to truly make effective trading decisions. So today, rather than a new game, I'm going to tell you a quick story about failing to consider the current situation as a significant part of the future outcome. Sometime back, Max Bazerman of the Harvard Business School was speaking to a conference of about 75 Wall Street moguls. Bazerman auctioned off a $100 bill with some interesting rules. Whoever won the auction paid their bid and got the $100. But whoever came in second or eventually gave up also had to pay his or her bid, but got nothing in return. Make sense? If you didn't win, you still had to pay your bid once it came down to just two bidders. Well, the auction was held. Any idea how much the $100 bill went for? $465. $465 for a $100 bill. How is that possible? Well, bidding got to 95 and then to 100. And if it stopped there, the $95 bidder would have been out $95 with nothing to show for it in second place. But if they bid $105 and won, they'd only be out $5, so they bid 105. But now the person who bid 100 was out 100, so they bid 110, and so on, and so on, and so on. Someone finally got the message at $465. Now, it's a silly story, but it sounds a lot like adding on to a loser or refusing to take a stop, doesn't it? Well, the structure of the auction was definitely not normal, but think about it. These bidders weren't idiots either. These were titans of Wall Street, controllers of billions of dollars. They just failed to consider the impact of their current actions against the inevitable future outcome. Bazerman says he's run this game at least 600 times, and he's never seen the bidding stop at less than $100. So with the notion of history, current, and future analysis, let's take a look at today's trading subject, volume cluster analysis. I'm going to circle back to the slide where I was slamming delta and cumulative delta analysis as not being viable processes to read the print. And you'll notice that under all of that mess was a comment about volume cluster analysis, what we call VCA. It's a single group of consecutive prices containing the highest concentration of volume in an individual directional move. In general terms, this is where the bulls and bears are fighting it out, a lot of trade on both sides, either establishing a continuation base or maybe a reversal point. More commonly in thick markets, this is a good trigger area for high-frequency algorithms to capitalize on confused speculators or to hunt for iceberg orders to front run. In reality, VCA is much more than just some profile of volume within a market move. But before we get into exactly what it can do, let's quickly go through the basics of what we're looking at. Right now, I'm showing you an OFA chart without any numerical volume information inside, just for the sake of simplicity while trying to explain this. We call this a structure chart. We can look at the order flow and the clusters together in just a minute. What you're seeing instead are the probe and rotation periods created by OFA And inside, I'm highlighting the volume clusters identified by the software as being significant nodes of trading volume. So, of course, the question is, what's significant? Well, obviously, that needs to ultimately be left up to the trader. Here you can see the same data set represented 4 completely different ways, depending on how we define the cluster concentration algorithm and our display options. See, rather than just looking for the highest volume, we're trying to define regions of substantial trade. If we're testing various alpha models, we may want to use volume concentration as a way to determine regime changes or mean reversion. Now, if that sounds like pig Latin to you and all you want is an easy way to read where things are happening, the basic settings are logical and they're simple to understand. So don't get lost in the vocabulary. It comes down to how much information do you want. Less is generally more useful for novice traders. The other thing people ask about is the different colors. We see red, green, and blue clusters. This is a classification algorithm used for pattern recognition processes. In the box on the screen, you can see 6 acronyms next to the colors, BIT, SIT, RS, and so on. These are classifications which can be defined by the trader, involving the spread between the cluster and the rotation point of a period. So assume you're a fib trader, and you may want to build a strategy that trades some combination of cluster transitions at or near some point, like a 618 fib. You could define what the actual composition of the included periods looks like. Perhaps a declining period with volume positioned neutrally away from the edges, followed by an advancing period where the volume concentration shifts above the previous cluster. Again, this can be as simple or as complex as you want. Changing the spread values allows the trader to define the exact composition of periods, and everything is available as a Ninja strategy variable also. So you could create, moving averages built from a sequence of clusters, or you could limit it only to periods with initiating or responsive trade. There's complete flexibility for advanced alpha models as well as simple basic settings for logic-based screen traders. And of course, you can define the colors used for clusters, candles, the background, anything else you can think of. So, settings aside, most people just want to know what it's good for and how to use it on a simple scale. So let's look at some straightforward screen trading concepts. First, you have to understand VCA has a deep capacity to display the short-term sentiment of an active market. Here we can see an initial dip in the trading, recover, advance a little, and then build a consolidation range before advancing again to the top. Now note that even though we dip down to form this little small range, the volume fails to break down below the other clusters within the consolidation. This is what I mean by sentiment. We can see that even with a direction change, there's not really any change in where the volume's trading. We then make a high, consolidate volume again before breaking over, and then you can see the sentiment change again from the low back up. So I can already imagine some of you are asking, so what? I can see the market moving up and down too. What good is any of this? Well, let me walk you through a few scenarios, and we'll think about how this might be paired with the order flow techniques that I taught you the last time I was here. This is a simple trend line. The only difference is I'm not using the highs or lows to draw it. I'm using the volume clusters of the move higher. This way I can see when the overall sentiment is broken and then dig into the order flow for a momentum entry. So right here, we see the breakover. Now, imagine that we can also see a sequence of strong bid prints in the order flow data. Just imagine that. That would be a short opportunity. Another thing that we can do is establish very simple value areas of volume. Look at the original transition from down to up. It didn't just make a spike down and then flip back up. There was a concentration of volume established in that transition. By understanding where traders formed a base of trade, we can use that area as a target for the short we just looked at, or as a region for a potential long. I mean, notice this is exactly where we traded into before reversing back up. And the same is true on the top, but we'll look closer at that in just a minute. So now let's put the two concepts together. This time we see a sentiment break occur exactly inside our value area. Okay. Imagine if the order flow showed a momentum buying sequence here as we came off the low. We'd have a great long. And as I mentioned before, we ended up trading right back up to the upper value area. And I want you to take note of something. Just like the first advance, we have this little downward pullback, but notice how it's supported by the previous volume clusters. Without penetrating this area, there's not really a change in the sentiment. Okay, so that covers some range-based concepts. Let's move over and talk about trends, and then we'll go through some real trades. In this example, we have a trend line lower across the declining clusters of volume. Notice that single cluster breaking out of the trend. That's our signal that the sentiment's broken, and we'll be looking for order flow momentum action to confirm it and give us an entry, hopefully right in the same pocket. Now, after that, we move up, and we get another sequence of volume. This time it's failing to come out of the 61s. So here's our sentiment confirmation, and again, when we look at real trades, we'll be searching for the order flow to provide entry and stop guidance, but once you see that cluster pop up and out, that's cracking the sentiment. So again, up a little and then dip back. And then notice how well those 61s were respected when we came back down. The prior resistance truly did become the new support, and it's pretty logical why. I mean, we did technically trade down below the 61, but we didn't ever print any volume below it. All of the volume's up above that. And now we have this straight line across 6250. And then we finally get that one pop of volume out, and the trend continues again. Now this last one was basically the same thing as the second one, but on a much, well, not a much smaller scale, maybe one period smaller. Here we're holding the 66s, and we get the one cluster out and pop, and the order flow takes over again. Another concept we like to use is converting price patterns to volume-based equivalents. So in this case, we have a declining wedge. We skip the highs and lows and just focus on the volume to draw the pattern. We see the single move out and would expect that the order flow is going to give us an entry and a stop, or tell us to pass, skip the opportunity if not enough evidence is there. Okay, so enough hypothetical stuff. Let's look at some real trades with the order flow and the clusters together. So in this first trade, you can see the value areas that I've established and the declining trend line of volume clusters. Okay? And as I zoom out, you'll also see actual order flow. And note that I'm in the process of drawing another secondary value area around the 6162 range high that was just made. So now there's actually three different value areas. The first one across 6364 and smaller chart, that was a momentum pattern down. That's going to be a targeted region. The bottom value area around 5657 is where I'm going to be looking for a sentiment change to hold it on. And the 6162 I just drew on the main chart, that's going to be an initial target, something to take profit at and mitigate our risk. And notice what's happening as we put lower into the 57 area. I keep adjusting that volume trend line, and we seem to be maintaining it. After we rotate from the probe lower, we start to see some strengthability offer. And notice I'm not jumping into a trade just because I see what looks like upside momentum. I need to see volume clusters break a trend. So you can see I'm eyeballing where to kind of expect this entry, messing around the 9. What I'm actually doing is trying to calculate the risk and reward of this trade before it even happens. I know the initial target is going to be about 61, and the bottom of this momentum is 50.75. So, you know, a tick below means maybe a 1.5 of risk to get at least 2 points, and hopefully 4 or more points up to 63 value. So once this trend is visually broken, I drop this trade in as the limit order 59, leaving the momentum print on the change in sentiment. We finally downtick into it, and it filled, and the stock gets moved along with the target. The downtake in the momentum holds nicely as the market goes back up, and the first target at 61 is got. And now what I'm looking for is a way to protect my profit. I generally don't use automated trailing stops because I figure between the clusters and the print, I can always do it better than a linear math. You can see the string of momentum that's formed there at 60.75 to 61.50, and knocking my stop right behind that makes good sense. As we come back out, you can see the other target region above around the 63, 64. Now, rather than a hard target up here, I'm just going to keep working with a logical trailing stop. The closer we get to that area, the more protective I'll be. But there's really no guarantee that we won't just blast through it. So I hate to put a firm target in and really limit the upside of trade. Okay, so we start to push into the zone. This is just another momentum print. So now I bring the stop up to 62. Now you can really see that we've entered the upper value area I marked off, and we're also starting to produce another volume trend line that we need to monitor. Okay, so as we push up again, our trend line select changes a little bit. And I can see that we're right in the value area that I marked off. This is a good time to really be protective. So the stop comes up to 63.50. And eventually we tap on my stop, and as the market depth drops, my order is sent. So that's a range trade with OFA and VCA trends and value areas. The next trade is actually from the trend example that I showed you earlier. Hopefully you remember the start from the still examples that we went through. We had a breakout, then consolidation, breakout, another consolidation, and then that long line of volume clusters across 6250. Well, we're at the upper end of the trend, and I'm looking for kind of one last entry to pick up a little extra for the day. The volume is, again, in a very flat pattern, and I need a cluster breakout to get out of the 66 area. Okay, so notice that we start lifting here with some strength at the offer. But what I really need is shift in volume to crack the sentiment back to the upside. So once the two match, I'm ready to jump in. Now the reason that I love this trade so much is because of the risk. I'm using the cluster and momentum to enter, and because I'm expecting a breakout continuation, there's no need for me to use anything but the same data for my stop. So just 2 ticks. Here in the structure chart, you can really see the breakout cluster, that one kind of popping up above in the last period. It's obvious that we broke that horizontal resistance, and dipping back down into that is just going to invalidate the trade. Now, because of how we've been trending, I have a small 6-tick target for the first contract. There's nothing special about it. Just part of the ATM strategy I had in Ninja to get an order out there. But even that's already a 3-to-1 risk benefit with that small stop. So it's fantastic, and we end up blasting right through it. And now you ought to be able to see the stop move opportunity. The momentum pattern is above 67.50, so that's where I move it. And keep in mind that with a trend trade, there shouldn't really be a set final target. But we do have ways of guessing where expansions might go to. The trick is to follow the print and protect your profits. All right, so we've got a nice print again. and I'm looking to improve my stop. You're going to see here that I actually end up with 2 stop moves because the action moves faster than I can even respond, which is always nice. So now we're up at 70. We're starting to really pound on the bid here. All right, now you can see that we had a lot of strength at the bid on the top of the last period, and it seems to be continuing here, and it really starts hammering against my stop. And when we come off of this and lift back up, I just make the executive decision to exit this trade and just hit the close button. There it is. Okay, and here's why. We have bid strength driving into my stop level. See the consecutive series of red price levels? Now I could have just let it get picked, but in reality I was able to pick up an extra tick just by taking advantage of the lift. In the end, my stop would have been tagged anyway. You know? Nothing I would have been able to do about it, but it's still about that management. So that's a range trade and a trend trade. I'm sure you have a lot of questions, but before I take them, I want to let you know that you can ask anything you want in Mike's forum as well as in our forum. On our website, it actually looks a little different than this now. We finally upgraded and got a real forum, but you can access it in the same place. Just go to our website and click the support forum link. Inside you'll find tech support, basic Q&A stuff, as well as free training videos and webinar recordings. So let's wrap up with a quick review of the benefits of what we've looked at in the context of game theory components. The first thing is strategy. We've seen how VCA can highlight trading opportunities just by drawing simple trend lines and value areas based on volume clusters instead of highs and lows. Second, participants. One of the primary purposes of VCA is to provide feedback on the sentiment of the market participants. I've shown you several examples today of higher and lower sequences of clusters showing the attitude of the market players. Third, payoffs. We've seen examples where the volume clusters provided not only the entry strategy, but also the target. And of course, common knowledge. The VCA study provides the ability to identify cluster patterns which expose specifically where the bulk of trade is being positioned. When combined with the logic of order flow analysis, we have a level playing field, and even a novice trader can begin to understand the rules of the game. Speaking of the game, we've changed it a little. OFA has a version that's completely 100% free to use. There's no trial period, no hidden fees, no required training. It's not a marketing gimmick. Just type in the URL here and you can download a totally free version that's yours to keep forever. It's not a limited trial. Play with it, see if the logic makes sense. Our objective is to be your most valuable resource for order flow trading. You don't have to buy anything. Our hope is just that if or when you do want to learn more, you'll come to us and help build the community. Mike, that's all I've got. I hope you guys enjoyed it, and I hope you learned something.
Okay.
I always want to be more than just a sales pitch, and let me know what questions I can answer, and thanks again for having me back.
Sure, DB. All right, guys. So if you have questions about anything you saw today or just anything in general, go ahead and type them now, and we'll see if we can get a few of those answered. All right, give me 1 second.
Take your time.
All right, Scott is asking, how does OFA work in a thinner market? Is it more useful on thicker markets?
Actually, the way that it's set up is so that you can have different settings for different markets. I mean, clearly, no market is going to be compatible to another one exactly. And not only that, there's going to be times of the day or different regimes of the market, different sequences of the market that aren't going to be like other periods of the day. So it's important to be able to change that around, and that's kind of one of the big steps that we took in this, was to make it revolve around the actual volume in the market or the different functions of the market. So I haven't really seen any limitations on effectiveness. We have people that use this in everything from oil to the pound. So that's a huge spread just in what's thick and thin. My background is primarily in trading E-minis, so that is where the bulk of development came from over the last 5-6 years. But you know, right now I hate the ES, so I trade currencies a lot more, and there's a substantial difference. You know, 2 million versus 200,000. So
right. Okay. Peter is asking, are you aggressively monitoring market orders? I don't know if that is a hint towards the delta formula or what exactly, Peter, if you want to expand on that question. But you know, do you pay close attention to market orders?
Well, yes, and I mean the basic concept of breaking down the print is matching the order with the quote. So a market order has to be filled into the other side of the equation. So somebody has to be offering something for you to buy into it. And the premise is obviously that there's an aggressive side to that. But I don't like to look at this thing in the traditional delta context. And I don't just mean one minus the other. I mean that I think it's foolish to say that because something occurred at the offer, that means that it must have been buyers buying into something. I mean, I'm smart enough to know that there's a buyer and a seller for every contract. So the way that we have synthetic orders that work these days, where people are not just going in and slamming the bid and lifting the offer, I don't believe that you can still utilize that same thought process of even 3-4 years ago, that the market order side of everything is what's important.
Okay. Eli is asking if you have any type of a trading room.
We do. I've always been kind of against this, and the only room we've ever had is one where I work one-on-one with actual students in support and things like that. We actually have an OFA trader who's been with us for about 5 years. She's extremely successful. She has started a trading room. She's been working it for about a month with a lot of our traders, and it's been really a great experience, not only for me to kind of get a little breather from the students, but for her it's been great to advance her trading just by really having to be kind of out in the open. I mean, there's no place to hide when you do that kind of stuff. And in addition, the traders that I've worked with, whether it's been for 2 months or for 2 or 3 years, have given us really good feedback. So there's a room environment. It's not something that I'm you know, we don't do the typical come in and get, you know, we're going to call trades for you and it's going to be a big marketing hoorah, and it's just, I can't stand that environment. I think that's those days are gone.
Okay. Speaking of one-on-one, James is asking if there's any type of one-on-one product demo or if you can get help one-on-one.
Absolutely. Absolutely. That's why I said, you know, what we're really trying to do is build a community of order flow traders here. And obviously we have a financial stake in that, so it's kind of like, you know, Al Gore saying that that he's not interested in the financial side of climate change. But yes, in short, if you go to the website, you can hit sales consultation, fill out a form. Someone will talk with you directly, show you exactly what all the different pieces are, how they fit together, talk about training options, talk about free options, talk about things that, just does this even fit into where you are? There are a lot of people that aren't quite ready to take a step into something this advanced. I mean, I hate to say that, but I think anybody that's been around the trading world for a while knows that you have to trip over all the garbage for a while before you figure out that maybe there's something else out there. So yeah, just fill out the form on the website, and somebody will be happy to work with you. If you'd like, I can work with you directly.
Okay. Reese is asking, do we need this particular volume profile program, or does this concept work with things, other things, other generic indicators?
Well, I'm sure you could apply the concepts, and really that's what I wanted to do here today, is not make it all about a sales pitch, but try and teach you something. And I know people develop their own things. However, that being said, I mean, obviously everything that we built is inside this software. So if you wanted to kind of match everything exactly as we're doing it and having the flexibility, that may be your only option. Just look at the forum that Mike runs. There's a lot of excellent stuff out there that's been built by other people. I think we're unique in the fact that I don't believe there's anybody else out there that compares volume the way that we do at the bid and the ask in the real relationship that they come into the market. But there's not any reason that it can't be replicated in some form or fashion.
Right. It's a double-edged sword. I mean, I know from personal experience, because I have a programming background, right? So I spent a lot of time programming stuff, and then I finally realized, am I trying to trade or am I trying to program? It's hard to change the mentality.
I've lived that for a long time, Mike. It's been a difficult road, and all of this started basically because the very first time I ever saw volume being presented on a chart, I was trying to make sense of it, and when I was looking at it and seeing how the comparisons were being done, it just didn't make sense at all. And I thought, but that's not how volume comes into the market. So I called 2 or 3 different vendors who were doing it at the time, and I think part of it has to do with they were fighting over a patent that never got, it got shelved. But nobody would help me, and I kept saying, listen, I don't want to sell anything. All I want to do is show you something that I think is important, and everybody just turned their back on me. So I built it myself, and it was a disaster. I mean, honestly, trying to go into the programming world is a nightmare. So, guys, the bottom line is none of this stuff is all that expensive. So, we have this is a retail product aimed at retail traders. Our previous product was aimed at a whole different altitude, and so this stuff isn't expensive. I mean, even one, you've got a free version of it. 2, the add-ons are all very inexpensive, and I can't imagine that you would want to break your head open trying to go through the programming, but you might.
Peter is asking if you can more clearly define a volume cluster.
Okay. Well, it's a sequence of the highest concentration of volume within any given auction or directional move. Okay, so the way that we define that I mean, obviously the algo is not as simple as here's the highest volume. There's some calculus involved in it, because what we're looking for is not the highest price in some movement. It's the actual concentration of volume. So we give you the flexibility to kind of define what that means, and that's why I said kind of early on in this that ultimately that has to be left up to the trader, but you also need some novice settings that are kind of universal, where you can look at it and say, I got to start making sense of this before I can dig into anything beyond that level. So to me, it means that when you're looking at a directional move, you're absorbing 3, 4, 5 consecutive price levels that all are the highest concentration of volume, and you can imagine that like a value area calculation would be a simplistic way of doing it. Just kind of define what the how much of the volume you want to include in that, and whether or not you want to include consecutive streaks of volume or different ones spaced out across across different levels.
Okay. Bjorn is asking what time frame were you using in the presentation? And I know you hinted on it a little bit, but you want to talk about how should someone select the time frame? What should they choose and why?
Okay. Well, for starters, we don't use regular time-based stuff. Everything that we did since the first ever build of the original OFA was based on directional action. So in the first couple of renditions of this, it was an extremely complex process comparing upticks to downticks and trades on the uptick to trades on the downtick. It was really kind of overwhelming. And then what we ended up doing was really simplifying that down into what essentially is kind of like point and figure charting. It's just based on directional moves. So a period can continue to move in one direction as long as there's directional action, and then when it reaches a certain point and pulls back, there's a variable there that cuts it off and starts a new period. So in the periods that I was showing you, we call that a probe and rotation. And if you're interested in how that actually works, I just did a free webinar on it that's on our forum because it's like a 10-minute discussion and you can see it really quickly. But I would recommend watching that. It was one of the webinars that I just did for our kind of new people coming in. And it's just the idea is that a user should be able to define what a directional move is, because in some markets that may be, I'll put it to you this way, the ES can be very slow and kind of grumpy and moving back and forth and back and forth. So if you were to use time-based something, you might see the market in a 15-minute period move back and forth over the same price levels 100 times or more. So you're just building volume on top of volume. And if you think about it from a trading perspective, if I jump into a trade and I get long, and the market doesn't move more than a few ticks one way or the other for 15 or 20 minutes, that's clearly not why I got into the trade. I'd be foolish not to have some systematic approach to exit that. So, it reaches a point where you say, how much of this volume is actually in the market? In other words, if an order comes in and comes out and comes in and comes out, you're just building this gigantic block of volume, but there's no directional movement to establish that it's actually, going somewhere. So I believe under those circumstances, you really can't read the print. For any of you who've ever tried to look at a time and sales window and you stare at it and all of a sudden there's just thousands of orders, there's 1 lots and 5 lots and 1 lots and 5 lots and all this stuff, and it's all, how are you ever going to amass all of that stuff? Well, it's the same kind of thing. Until we actually see the market move away from something or into an established range, then that's when you can see in the print that there's something definable, patterns that you can recognize. I don't claim to be the end-all to information on this. It's just when I look at a chart, I kind of have that imperial data mining background where I don't really care about a lot of the theory and things like that. When I see patterns, I want to dig into them and see if they can be replicated. And what I find is the patterns that can be replicated are the ones when the market is moving directionally. So our periods are not really time-based. They're more like a point and figure chart. We also, most of our traders use a lot of point and figure because it's that unambiguous kind of this is a buy and this is a sell and you can't argue with it. So it makes it really easy in that sense. So I hope that answers the question. It's not an easy one to answer, but if you really want to dig into it, there is a short video on it.
David is asking about the impact of high-frequency trading. Anything you want to say about that?
Yeah, I think there's a huge impact of high-frequency trading, and if you let me start by saying I know very little about this area. I'm very interested in it, and I'd love to know more. But I also am not going to go and get a master's in financial engineering and actually have an opportunity to see behind the curtain of a lot of the things that are going on. Through the books that I've read, that anybody even with a little bit of a trading background could follow along. Things like Inside the Black Box is a fantastic book that kind of addresses this. The notion of high-frequency trading has grown so much, and there's kind of a bad stigma in the press that goes along with that. but in reality, they're taking advantage of patterns in the data, no different than what I do. And one example would be hunting for iceberg orders. You've got these hidden orders that people can't see, but when they get tripped into them, then can the high-frequency algo jump in front and front run where some of the iceberg is coming in. Those are things that get reflected in volume clusters. You see that churn, you see that action being dug into, being just moved a little bit, moved a little bit more, moved a little bit more, and then finally there's enough action to blow it. But I don't know that it's truly something that affects what we do, because we're kind of doing our best to interpret that. So I'll just kind of end it by saying this is something that I'm not really qualified to make a broad statement on, but I'm very interested in it, and it makes a lot of sense to me, and I think that a lot of people don't know quite enough about it.
Right. Bill is asking about his question is, you appear to be using level 2, and level 2 is cached on your system platform. He uses Kinetic with NinjaTrader, and he wants to know how compatible the indicator, the OFA indicator, would be. So I think he's essentially talking about the bid-ask backfill. Do you want to talk about that part of it?
Sure, I will. Any of you who have dug into NinjaTrader and done some of your own programming have probably hit some brick walls here and there. It's not any, listen, I'm a software developer too, and there are people who complain plenty about what I do, but there are some limitations, and one of those limitations is that, and you can look at when you build a chart, you can look and see, you can either pull the last trade price, the ask price, or the bid price. You can't pull all three. Okay, so the way that they've set it up is that technically you really cannot pull the order flow data historically. Now, I don't know exactly why that was put in place. I know in the case of Kinetic, I think everybody by now knows what the Kinetic feed is, and if you don't, I'm not going to be the messenger here, but you can Google it, and you'll find that it's it actually is another feed, yeah. And there's a limitation to it. Yeah, thanks, Mike.
It's not
it is IQ feed, and yeah, I mean it's not a secret, but it's IQ feed, rebranded, and one of the limitations of that, and why it's $10 cheaper or something, is because they limit the amount of data that you can access. They're not going to have people pulling tick data off of IQ servers, right? So that may be why they have that slam in the middle, but we basically had to hack around it. And I use the word hack not in the black hacker sense. I mean, looking at a program and seeing how do we get around this. So yeah. The problem is that you have to access an API directly in order to get true historical bid-ask data.
Right.
Now, the way a lot of programs do this in NinjaTrader is to use an uptick, downtick method. So if they go back and look at the data and they say, well, this was an uptick, then that had to happen at the offer. If this was a downtick, it had to happen at the bid. That's really not order flow analysis. So, that's the limitation. So at current, we only support IQ feed as a backfill. There are a lot of other good data feeds out there, and we'd love to work with them, but it's kind of a hassle, and I think we all know that NinjaTrader 8 is coming out. We don't know when, but we all know that it's coming out, and it's one of those things that they know that they have to make that data accessible. I've had good conversations with NinjaTrader. They're making that progress. So I hate to go into a full mode of development for a bunch of different feeds, when honestly, if you know the difference between clearing data and subscription data, you want to be on subscription data if that's what you're trying to get. If you're trying to analyze tick by tick, you need really good cleared data. So
first of all, I just want to kind of clarify that it's not like, I mean, IQ feed is generally regarded the best in the industry, so I don't want to make it sound like that we were hiding IQ feed for some reason, because Kinetic is just a less expensive version of IQ feed that works only with NinjaTrader, so there's nothing wrong with it at all.
No, it's very good data. You're correct. I just meant the limitation is that a programmer can't get into it directly.
Yeah, I remember this coming up a long time ago, years ago, when Ninja 7 was in beta, and I think that the developers just misunderstood what the users were really wanting, because there is actually a bid-ask storage mechanism with Ninja 7. It's just not aligned with the last trade, so it doesn't really work. So now, that was just like a, the developers aren't traders type of thing, I think, if my interpretation. So it's been fixed in Ninja 8. But anyway, moving on.
Yeah, and again, I mean, that's one of those things where hopefully it comes really soon, because then we don't have to do anything but convert everything over. So
yeah. So
I just want to say, if there's anybody out there that like desperately wants to use their CQG feed, or if it's that important to you, we can write it. We can, but you're gonna have to pay for it. I'm not gonna go out and do the development for free on it. So.
Right. Yeah. Ray has already said Ninja 8 has it, so just gotta hang on for that.
I agree.
Before we keep going on some of these questions, I see a couple people commenting about that they filled out the form on that URL, and I don't really understand, so let me just read what they're saying. They're saying that they fill out the form and it says that they need to attend a webinar. Is that today's webinar, or is that a different webinar?
Gosh, Mike, I just realized that I used the banner ad URL here instead of just a direct form. Just so you know, fill out that form. Don't worry about attending the webinar. I mean, obviously, if you want to come to a free webinar, that's fine, but you should automatically get another form for you fill out a form to register for the free software.
Okay.
You don't have to do anything. Nobody's trying to milk you for anything. There's no even the webinar is free if you want to come. I do webinars every Tuesday just to kind of because we have so many free users that are just trying to get a feel for what this is. And I don't blame you. I mean, this is something that to a lot of people is very different. So take time and explore it. But I'm sorry if the link isn't going directly to a download, but at some point you should reach a registration form, fill that out, and it'll put you in the system and send you the download in an email.
Okay. All right, let's try to do just a few more questions here if you have time. Let's see. I'm trying to consolidate some questions asked multiple times here. Okay, so getting back to data feeds for a second, what if somebody is using a data feed that maybe is not so great, like, for example, interactive brokers? Any comment on that?
What the problem is with it?
Yes, sorry, my phone. I mean, interactive brokers kind of, I mean, I use IB. I'm a customer of theirs, and it's great, just not their data. Their data is not good. So.
And in full disclosure, I'm an IB customer as well. The problem with the data, and this is one of those things that it's like we need to have there's got to be a post on your forum about this, Mike, but there's a difference between okay, all right. Well, there's just to kind of, I'll give you the quick summary. There's a huge difference between a clearing feed, which is designed to get your orders from your computer to the broker server to the exchange and back, and a subscription data feed, which is the only purpose of that one is to go the other direction and bring you data. Okay, so when you have a clearing firm like IB, oftentimes what they do is consolidate the way that the trade data is reported, because the majority of their clients are trading on a different realm. They're stock traders or something else. They're not a tick-by-tick, unfiltered data, that's not what they specialize in. Yeah. So what they do is they send you a snapshot of a whole bunch of trades packeted in like 25 milliseconds or something like that.
Right. Yep.
And when you get it, it doesn't have any correlation to whether it was struck at the bid or at the ask. There's no matching. No trade matching goes on.
Yeah.
So that's the main difference. And I just always tell people, this is something that, IQ Feed will give you a free trial. This is something that you can use with a lot of the data vendors that are out there, in a live-only mode, which is sometimes perfectly fine to do an evaluation of whether or not this is worth looking at. And then you can say, look, if this is really what I'm doing for my job, is it worth me paying to have really good subscription data? Well, if your job is to analyze data, you better get good data. I think there's a saying by a bunch of quants who say, I'll sell you my kids, but I won't sell you my data. And that's the thing, is that it's all about getting the best possible data so that you can do the best possible analysis.
I use interactive brokers, and I have for forever and a day, but it's just for equity trading. I would never use their data in a futures market on any type of tick or volume-based chart. So, Lane, the answer to your question is don't use IAB. If you want to, there's a thread. If you guys are elite members on BNT, just do a quick search for bid, ask, comparison. Those 3 words. There's a thread out there that has hundreds and hundreds of posts where everybody has done all kinds of analysis on all the major data feeds and talked about, how reliable they are for this type of data analysis. So check it out. Okay, moving on here. Lots of these we've answered. Let's see. Sorry, we've covered a lot of these actually.
Okay.
So a lot of people giving you good feedback. He's a customer, happy with your service, good webinar. Okay. Sorry, I'm just consolidating here.
Not a problem at all. And like I said, if you don't get a question answered, you can get it to me. I will respond. We don't have a giant room of people who just reply to a forum all day. We do everything ourselves. So if you have a question, don't hesitate to ask it through the forum or just through the contact form or anything like that, and we'll get back to you. That's why we're here.
Right. All right. So I think I'm going to ask one final question that I think I saw a couple different people kind of hint at. So I'll kind of make it my own question. So some people were asking how similar the work is that you're doing. How it compares to like traditional volume spread analysis or Wyckoff methodology volume analysis or volume profile, like I don't know. I mean, if you mentioned the word value areas, right? So there's obviously the concept of value area high, value area low, and volume profile. Do you want to take a quick stab at how all these different strategies or methodologies that use the word volume, how they differ from what you're doing?
Sure, I'd love to. And I didn't mean to mislead anybody by using the word value area. A lot of times we use terms that have parallels in other methodologies. I was just talking about the idea that when you're looking at the high or the low of a market, very rarely is the emphasis on the actual top 2 or 3 ticks. It's usually somewhere inside of that where there was a change in the actual sentiment. So we kind of look at things in terms of from the cluster of volume to the high or from the cluster of volume to the low as being an area of value where we might see targets or things like that. But in direct response to the question, I think that there are phenomenal methodologies out there, and they don't actually intertwine with what we do very often, other than the fact that they're excellent to use with OFA. We have a lot of traders that are volume profile traders, and they're either on one side of the fence or the other. They're either truly mean reversion traders, or they're using a profile to look for those breakout days and matching OFA with it, just as you would if you consider a value area, an upper value area, as a pivot point. And that's where you're looking for a reaction. I believe in the idea that you should have a decision point in mind where you need to make a decision, and that's what separates somebody that is actually truly kind of a discretionary screen trader and somebody who is just jumping all over the place. Is being able to break down a chart, do their analysis, and then say, okay, this is where I'm going to take action, or I'm not, depending on whether or not I get the signals that I need there. I don't know much about volume spread analysis. That's been around for a long time. It's just something I've never dug into. But my belief is that if you're not looking at the volume in some context or another, you're missing a huge piece of what's on the chart. And we live in still in a very two-dimensional charting realm when it comes to trading. But when you really think about where trading has come in the last 2 or 3 years and where it's probably going in the next even sooner than that, into where basically everybody can be co-located in the through cloud connections and things like that, I think you're going to see a lot more three-dimensional modeling, and to me, I've always looked at volume as that third dimension, and although it's still a two-dimensional chart, that's something that in any context you ought to be putting into some sort of analysis.
I agree completely, and I was just thinking for a moment how that related to my own trading, because I can remember myself several years ago discarding volume as not being important. I was even thinking of a particular quote that I used to say, being naive back then, that it doesn't matter what volume says, because my stops and my targets are filled on price, so I only care what price does. But I have become a bit smarter in my old age. Yeah, and I pay a lot more attention to it now. I mean, I think I'm a volume profile guy, and I'm not a scalper, so what I do doesn't really translate to what most people on the forum are trying to do. But anyway, volume is important and should not be discarded. All right, so
Absolutely agree.
Okay, I think we've covered just about everybody's questions. If I skip somebody's question, let me just ask, what is the best way for people to ask questions to you, DB?
The easiest way is either through your forum. There is an Ask Me Anything forum.
Right.
And then also to go to our website and click on our forum. And there's a Q&A section. Just post anything you want. You can get feedback not only from me but from other traders. And right now the forum looks empty, but it's because we just migrated to a new one, and I'm too lazy to move old posts over.
Right. Okay.
But ask. Just that's the best way is to go and get yourself familiar with it by getting engaged in the environment. And there are no dumb questions. We realize this is, well, I take that back. There are some dumb questions, but usually there's not dumb questions when it relates to something that you really want to know about. And so don't hesitate to ask away. We'll be very quick in answering and help you out in any way that we can. Okay.
Is there a part 3?
If you'd like me to do a part 3, we can. I mean, trust me, I have more material than I know what to do with. If some cruise ship would hire me as a stand-up, I would. That's where I'd be. But
oh man, speaking of cruise, I can't wait. I'm counting down the days. So
I'm so jealous. I'm so jealous, man.
I'm out of here tomorrow. I'll be back in 3 weeks. So
your last 3 emails to me have been all things that I want to do, but I generally do all of that during Christmas because the trading is just so. I either hit late August. I usually go someplace where it's not so damn hot.
Right.
I'm just south of you in San Antonio, but anyway,
yep.
Guys, I really enjoyed it, and Mike, thanks so much, and I'd love to do a part 3. If you guys really want to get into the game theory part of it, maybe somebody can put some things on the Ask Me Anything and give me some ideas, or do you just want it to be more about order flow? Because it's such a fascinating kind of combination of the two things, and I try and just not overwhelm people with economic theory and stuff that maybe doesn't directly relate. So,
right.
A quip here or there. But it's kind of like the last one that we did with the game at the end to see who was going to manage the fund.
Right.
And when you think about it, I mean, if you don't understand who you're competing against and what their objectives are, and it's not like we know what everybody's objectives are, but if you don't understand that when you wake up in the morning, if you're a trader, you better look in the mirror and say, I'm taking somebody's money today, because it's not just out there for the plucking. You have to be that way, and you need to get a strategy in order, and it's really a critical component to understand those 4 pieces, and that's why I like to tie it up with game theory.
Right. Okay, so if anybody is hunting for that AMA thread, you can just, on the top right in the search bar, you can just type in AMA, and you should be able to find it pretty easily. There's not too many different AMA threads. All right, so thank you, DB. Thanks for putting together the presentation. Thanks for spending time today and answering everybody's questions. I will post the recording of this on our YouTube channel sometime tomorrow, where you can find it on BMT. And I'll see everybody on the forum. Thanks, guys.
Take care, Mike.